Welcome to this video on the $150,000 rule, 2026 Roth 401k catch-up changes. A significant change takes effect January 1st, 2026, which could impact high-earning professionals. Here is what you need to know now. The retirement landscape is shifting fast. Following the Secure 2.0 Act's new required minimum distribution rules, another major change is coming. Minor rule tweaks often mask the biggest tax traps, and this is one of them. The $150,000 rule, found in Section 603 of the Secure 2.0 Act, mandates that if you are age 50 or older and your prior year's employer wages exceeded $150,000, your 401k catch-up contributions must be Roth after tax. Pre-tax catch-ups are gone for high earners. This means no more deducting catch-up contributions if you earned over $150,000 in the prior year. Specifically, if your FICA wages exceeded $150,000 in 2025, you cannot deduct those catch-up contributions on your 2026 tax return. You'll pay taxes on that money up front. Here is a look at the 2026 contribution limits. The base limit of $24,500 can remain pre-tax. However, the catch-up portion is automatically forced into the Roth side if you exceed the $150,000 income threshold. The new Super Catch-up allows those aged 60 to 63 to contribute an extra $11,250. But if you exceed the $150,000 income threshold, every dollar of that catch-up is Roth only, meaning no deduction and no pre-tax benefit. The loss of an $8,000 to $11,250 top bracket deduction will increase your current year tax liability. However, the silver lining is that all that money and its compounding growth will be completely tax-free in retirement. This law mandates a Roth approach for high earners' catch-up contributions above the threshold. This means paying taxes now for tax-free withdrawals later, which is beneficial if you expect tax rates to rise or your income to stay high in retirement. This change presents a major headache for business owners. If your company's 401k plan does not currently offer a Roth option, you have a compliance problem. If a plan doesn't offer Roth contributions, no one in the plan can make catch-up contributions at all. Plan sponsors need to act before the deadline. Amend plan documents to add a Roth option before January 1st, 2026. All plans within a controlled group generally need to align on these features. Finally, ensure HR and payroll systems route contributions to the Roth side for qualifying employees. The $150,000 threshold is based specifically on FICA wages, which is Box 3 of your W-2 from the preceding year with that specific employer. For the 2026 tax year, your 2025 wages determine your status, so check your 2025 W-2 Box 3 now. It's important to know the $150,000 threshold is employer-specific. If you work for multiple employers, each relationship is evaluated separately based on the FICA wages that employer paid you in the prior year. Your 2026 action plan has 3 steps to avoid surprises. First, check your W-2 and verify your 2025 Box 3 wages against $150,000. Next, confirm with HR if a Roth catch-up is offered. Finally, adjust your budget to plan for a potentially smaller post-tax paycheck. For Step 1, pull your 2025 W-2 and check Box 3, which is Social Security wages. If this number exceeds $150,000, your catch-up contributions in 2026 are automatically Roth. Remember, this applies per employer and is not combined across multiple jobs. Step 2 is to talk to your HR department. Ask directly if your 401k plan currently accepts Roth contributions. If the answer is no, you must push for a plan amendment before the 2026 deadline, or catch-up contributions will be prohibited for everyone. Step 3. Adjust your budget. Roth contributions are after tax, so your take-home pay will decrease compared to pre-tax catch-ups. Expect a bump in current year tax liability. However, the trade-off is completely tax-free growth later in retirement. Who is most affected? High-earning employees age 50 and over, earning $150,000 or more in FICA wages, must now use Roth catch-ups. Business owners must amend plan documents to add Roth or lose catch-up contributions. Plan sponsors and HR are responsible for updating systems before the deadline. Work with a tax professional. Running tax projections now, before 2026, is critical. A qualified tax advisor can model the impact of losing your pre-tax catch-up deduction and help you optimize your overall retirement strategy around the new rules. Key facts to remember include the effective date of January 1st, 2026, and the $150,000 income threshold based on FICA wages from the prior year. Remember the catch-up amounts, and that plans without a Roth option must amend or lose catch-up contributions entirely. Don't get caught off guard. Check your 2025 W-2, confirm your plan's Roth status, and adjust your budget now. If you have questions about your specific situation, consult a qualified tax professional before January 1st, 2026.